Arindam Ghosh, Chief Executive Officer with Blackridge Capital Advisors. Arindam, fantastic to have you back. Good morning and thank you for joining us. Many experts are of the view that Fed has officially changed their communication on interest rates. If that is the underlying thought, market should be in a panic mode, but that is not the story.
Well, morning, Nikunj. I think clearly the message from the Fed chairperson was quite dovish and clearly along expected lines. What essentially she articulated was that it's moving away from its earlier preset course and pegging it to the singular peg of 6.5% unemployment band. And moving to a more, flexible approach with a wider basket of variables. So I think that's basically, the shift which has happened. As far as, the timeline for raising interest rates is concerned, I think more or less, the timeline of 2015 mid, more or less stays valid, give or take probably a quarter or so. So I think it's been along expected lines. Probably what the market has been feeling a little edgy and uncomfortable is that, there is an element of uncertainty which probably has crept in because now you're moving towards more, qualitative measures which are going to define how Fed is really going to act going forward. But having said that, she has been also quite definitive in announcing that it's going to be 6 months, from the time the QE ends. So I think you have a mix of both. Every time I think there has been an announcement of, the tranche of 10 billion taper, the initial reaction has always been a little negative. But then, the market has always taken it into their stride and kind of, continued their upward march. So I think that should be the case this time as well.
Arindam, what's the sense that you're getting about our markets though? We've been holding out pretty okay. We've been staying put at 6,500. We've been getting consistent, FII buy figures on a daily basis. From now up until the elections, do you think there could be a significant move higher from these levels as well?
Well, India has actually been standing relatively tall compared to some of the other BRIC nations, and that's partly because of the improvement in the macroeconomic, fundamentals, and also because, there is a tremendous amount of anticipation in the minds of global investors, of an outcome where we are going to see a stable government, probably unleashing a new set of reforms which is going to revive and kickstart the investment cycle. So I think that's basically been built on a lot of hope. But I think once we have the election kind of going out of our way, it'll obviously be the earnings and how strong the corporate earnings are, and that's what is really going to drive the markets. Unless we have some spoilers, in the form of monsoon, etc., which can be, a dampener. Overall, we expect, the Indian economy to kind of definitely exhibit and show, stronger signs, from here. And that is what has actually been, primarily been attracting foreign flows. And that trend is going to continue, and that's going to continue beyond the elections. Of course, in the run-up, we may see some kind of, technical pullback and profit-taking along the way. But overall, I think over a 2-3 year, 5 year kind of perspective, the trend definitely looks very, very positive.
And I stumbled upon a Goldman Sachs report 2 days ago, and that report seems to be making a case that 4 out of 5 times in the run-up to the election, markets have always gone up. And in 2014, the scenario is no different. Do you think rather than linking this current leg of rally with better earning prospects, decent macro governance, we should simply read into this leg of the rally as a pure pre-election rally, nothing more, nothing less?
Well, I would differ from that argument, Nikunj, primarily because, fundamentals definitely have also been playing their part in kind of restoring a fair amount of foreign investor confidence, which has actually got rebuilt, over the last, 5-6 months. And whilst I think a lot of that flow which has actually been coming, I would say rather disproportionately to India, could also be because of the fact that China has been a little under the weather and probably is going to stay like that for quite some time. And I think as long as we have soft data coming out of China, that can actually work in favor of countries like Korea as well as India, and that probably would get would continue to be beneficiaries of foreign flows. So I think that's one side of it, but at the same time you cannot ignore that fundamentally the economy has improved significantly from what it was and where it was. Whichever way you look at it. So, today we have a situation where the inflation has actually been going down, trending down, and I think that gives a lot of confidence, to central bank to kind of, try to focus on growth, and that I think is what is going to be the theme, going forward, to try and see how growth can be actually revived, how the investment cycle can be revived. That does not kind of take away the fact that between the DMs and the EMs, there is increasingly a strong polarization which is happening, and it's getting bubbled out, right, considerably. So, we have very contrasting macroeconomic variables which are at play at both the DMs and the EMs, right. But overall, I would say India has actually been doing a lot better.
TCS has indicated that the current quarter could be a flat quarter for them, but FY15 will be better than FY14. So market should actually be rejoicing that comment from TCS. In fact, yesterday markets punished that stock. If the management of India's biggest IT company feels that FY15 will be better than FY14, market should reward that stock.
Clearly, I think, that was kind of a knee-jerk reaction which we saw yesterday, which resulted in the hammering of, some of the frontline IT stocks, barring a few exceptions. But overall, I think there is reason to believe that on a 2 to 3 year perspective, IT is going to continue to be the dominant sector. So I think long-term investors, shouldn't really get faced by what a quarter-on-quarter guidance has really come out or has been coming out from some of the sector leaders. We need to bear in mind that we are in an environment where US has already been exhibiting stronger and stronger growth. EU is on the recovery, and in that kind of a backdrop, things are going to look increasingly better as the outsourcing demand picks up, from that part of the world. Of course, one needs to, keep in mind that, the kind of follow-through that we got from, the currency may not really be valid, over the next 2-3 quarters. But I think purely on the back of, growth, both top line and margin on account of, business which is going to come in from that part of the world, is what is really going to keep the story intact as far as the IT companies are concerned. So I don't think there is, in fact, the sense is that whenever these kind of a panic reaction happens, these are good opportunities for long-term investors to kind of take positions with a clear 2 to 3 year perspective.
Do you think Nifty could go to 7,000 before 16th of May, or there are too many fault lines and no ways Nifty could go to 7,000?
Well, it's indeed a difficult question, Nikunj, to kind of hazard a guess on how the Nifty is going to move in the run up to the big event. Our sense is that I think we've already seen, and I'm not just talking of how the Nifty has actually moved from start of this calendar year. There are no fixed dates, to the starting point of a market move. But if you just go back a little, I think we have seen a fair amount of up move, from where we were, 6 months or 9 months back. And I think the market has kind of, now already priced in a certain election outcome. So I really don't see the market getting into some kind of a tear from here. A lot would now depend on what happens in terms of the results and, what kind of government gets formed. And that's when I think, we would have some kind of a, fundamental reality check. And post that, I think, we would see the larger or bigger up moves, after, consideration. So I think probably, one should kind of, stay a little, cautious at these levels. But overall, I think the trend would continue to remain, on the up move. So our sense is that a 4 to 5% kind of an up move is what we would kind of, expect at best.
Arindam, appreciate your time and thank you for joining us.